Are you or someone you know looking to buy or sell a home? When you use a HomeGain Realtor to buy or sell a home, you can get $150. Visit HomeGain.com and click on the Promo 150 banner at the top of the page to get started. Compare HomeGain Realtors and choose your favorite. Complete your home purchase or sale transaction with a HomeGain Realtor, and HomeGain will pay you $150. Get started today by going to HomeGain.com. Welcome back, everyone, to Real Estate 360 Live. I'm your host, Ryan Sloper, joined today by my guest, Cammarosano, the general manager of HomeGain. Quick reminder, Real Estate 360 is designed to build the Washington, D.C. Metro's housing and credit markets one house at a time. If you ever have any questions or concerns or real estate needs, the best number to reach out to us is 877-245-2030. That's 877-245-2030. Or via the web at realestate360live.com. That's realestate360live.com. On the right-hand side, there's an Ask a Question button. Just click that, and I'd be glad to get back with any of the answers to any of the questions that you guys may have. So I want to jump into this week's Market Movers. This segment was brought to you by HomeGain. HomeGain is the place to get you started buying or selling a home, finding a realtor, and getting real estate questions answered. Go to HomeGain.com today to see what I'm talking about. All you have to do is type in your home's address. You'll get an instant free estimate of your home's value online. It's a great way to monitor your home's value, and it's totally free. So check that out today at HomeGain.com. So as far as what's on deck this week that can affect interest rates, we've got the June existing home sales. We have the June industrial production and factory usage, June housing starts and permits, the July Philadelphia Fed Business Index, and June leading economic indicators. And on Thursday, the Fed will release its beige book. This is where the Fed details on the economy in the 12 different regions. Obviously, the 10-year note sets the pace for the mortgage markets. I've been saying this, week after week, that typically, if you follow that 10-year note, you'll see that the 30-year mortgages and 15-year mortgages are typically, go hand in hand. If the 10 years going down, mortgage rates tend to follow right in the same path. Mortgage rates have generally been unchanged over the last week or so, although they did tumble down a bit after the weak jobs report at the end of last week. According to Freddie Mac's latest primary mortgage market survey, it showed average fixed-rate mortgages rates finding their record low again. The 30-year fixed average 3.56%, and that's with charging 0.7 points for a discount fee or origination for the week ending July 12th, which is down from 3.62% the previous week. At the same time in 2011, the 30-year fixed rate averaged 4.51%, and this week marks the 16th straight week that the 30-year average has stayed below 4%. That in itself, Lewis, is incredible that, we've had, literally for 16 straight weeks that it's been below 4%. Phenomenal rates in the 15-year fixed fell to an average of 2.86% with a 0.7 points of origination or discount. Now, remember, guys, this is all based off of, probably loan amounts that are over $200,000 and having great credit scores. So when you see these averages, and this brings up another very great point, if you're just going online and you're looking at interest rates, please be cognizant of the fact that everybody doesn't have every one of your financial details that they need in order to give you a quote, because you can look at where the average interest rates are, but all that's telling you is that in a pool of 100 people, what the average deal that those people got. You might have some people that have 640 credit scores. You might have some that have 720 or 800. Unless you give all the details to a mortgage professional and they can look at your financial situation, it doesn't necessarily mean you're going to get the average rate. You might be above the average rate. You might be below the average rate. Don't assume. You need to reach out to a professional. 877-245-2030. That's 877-245-2030. The chief economist for Freddie Mac attributed the falling rates to easing Treasury bond yields following June's disappointing jobs report, obviously. I feel like that, Lewis, these jobs numbers are going to continue to be lackluster for probably an extended period of time. I don't see any of that changing, as well as having the Fed on board with trying to keep them low for a sustainable period of time. I could see a case where we might be sub 4% for the next year or so. Would you agree?
They'll do everything they can to keep those interest rates low, and Operation Twist, QE3, coordination with the European central banks. So yes, absent some dramatic event that actually blows the lid off of all this and puts interest rates back to where the market would suggest they should be, they'll remain low.
Yeah, and it's interesting because everybody's like, oh, they're really doing so much to help us by keeping these interest rates low. And little do most people know that the real reason that they're doing this is because in order to manage the debt load that this country has, they have to keep interest rates low.
Absolutely.
And I want to emphasize that because before you go patting the government or the Fed or anybody on the back thinking that they're doing you a favor by giving you these low interest rates, it's not really that. And take that a step further. If that was really the case, then I believe that the banks would work hand in hand with the Fed and the government to relax some of the underwriting guidelines to allow for more people to qualify for these loans. But that's not the case.
Right. They're not as interested in loaning money in their mortgage portfolios. They're more interested in trading, and they're more interested in getting paid back by the sovereigns. So they need to keep interest rates low. And the government has the same objective. They want interest rates low to keep their cost of borrowing low so they can continue to spend, and by spending, offer things to the population to get reelected.
Yeah, and it seems great. I mean, you figure the people that are able to take advantage of housing right now, Lewis, obviously might have like a positive reflection of the president and the Federal Reserve and everything else. And I mean, you guys do a survey, right? Wouldn't you feel like a lot of these things for people that have bought in the last 6 months and were able to take advantage of the low rates are going to have a different feel for, how the president's doing overall? I would think that would be a major thing. If, I was a first-time home buyer and I got in at sub 4% interest rates and I have a job and everything's kind of going pretty well for me, they're going to have a different take on what they feel about the president from somebody else that is upside down on their home. They can't modify their loan. The bank won't work with them, and they're pretty much screwed.
Well, sure. Most people don't have any understanding of economics and no real interest, so they only look at their own personal circumstance, and politicians play off of that. And then the people that do understand economics, most of them don't really understand economics. They've been force-fed Keynesian economics, which is not really economics. It's more of a justification for public policy and government spending. So most people are not going to get to the real issues as to what makes an economy work, what makes it grow, what makes it doesn't grow. So you're right. People are going to look at their own circumstance, and politicians can exploit that because they can create environments where they can say, either you're better off or I'm doing something. Look what I'm doing. Even though if you were trained to look at it, you say what you're going to do is a disaster, it still sounds good and it'll get people to vote for them. And then they can always blame some other reason why it didn't work out and why they need to spend more money or try a new scheme.
And that's why, it's funny because, all these government programs that are out there where there was HARP 1.0, HARP 2.0, now they're talking about HARP 3.0 because the initial HARP 1.0 was supposed to help some 7 million people. That didn't work out, so they went to HARP 2.0. HARP 3.0 is out there because it needs to help more people that aren't involved with Fannie or Freddie that have, their loans serviced by somebody outside of Fannie or Freddie. Well, guess what, guys? I mean, do you really think that these private banks are really going to want to join in if the government's not backstopping the losses? They're not. They're not.
Ryan, if you look at the history of depressions and so on, the one that end the shortest is when the government does nothing, and the one that was the longest was the Great Depression, when you had massive amounts of government intervention into the economy. The Depression of 1920, which no one really talks about much, only lasted a year and a half because the market sorted itself out. And right now you've got the same circumstance. You've had this recession going on for years, and it's not because the government hasn't spent a lot of money, the first stimulus, the QEs, the low interest rates, and so on. The only thing that actually fixes the economy is when it actually readjusts itself to its natural equilibrium. And right now, if people are in debt, they should be rebuilding their savings and eventually, selling these homes off for the prices that the market will bear. And the housing market will correct itself. The economy will correct itself, but you just have to step back and allow it to happen. And when you get central planning and intervention by the government, it only makes it worse, but it looks like you're doing something, and it looks like you're trying to make it better, and therefore people vote for you.
Yeah, and
and you get more of the same as a result, because you're never going to get elected saying, I'm not going to do anything.
Yeah, and
I'm going to let the market take care of it. Then you're viewed as some kind of heartless capitalist that's just going to let people get kicked out into the streets.
Right, and one of the biggest questions that I get from listeners is that this is great that interest rates are so low. I owe $200,000 on my house. How can I refinance and take advantage of these? And the majority of them are upside down, and unfortunately, there's not much that you can do. However, a couple of of weeks back or shows back, I did mention that a lot of people now, what they're actually doing is they're trying to get creative and find alternate sources of money via their retirement fund to be able to potentially put some money down and pay down their loan to get to a point where the bank would consider making a loan for them. Do I think that that's a smart decision? Me personally, I think it is. Because if you're able to borrow money from yourself via your retirement vehicle and you might only pay, I don't know, it varies from one plan to another, but maybe pay 3 to 4% to take and pay down your loan to get to maybe an 80% loan to value to where you could refinance your mortgage, whether it be your second home investment property, to interest rates around 4% or lower, depending on what type of home that is or whatnot. I think it makes great sense because, once again, you're locking in a mortgage payment for 30 plus years, which is a phenomenal interest rate. Now, if you didn't, let's just say you didn't do that and you kept your 6%, you're just going to be stuck with that. Is 6% a bad interest rate? I don't think so. I think that, 6% and under are phenomenal interest rates just because historically, I mean, we're at one point, interest rates were up into 18, 19% and people were still buying homes. To keep and capitalize on the extreme low interest rates, whether it's your primary residence, second home, or investment property, and you have the means to get the money to make the refinance transaction work, or to be able to borrow money from a relative and pay them back to purchase now versus waiting another year or two, I think it makes great sense.
Yeah, anytime you can reallocate capital and make it better used.
And, sometimes too, Lewis, I think sometimes just talking with a professional that knows a lot of options and that can ask the prudent questions to say, well, is there somebody that's maybe willing to co-sign for you and stay on the loan for a year and then you can refinance them off a year later? You have to be working with a professional that has many options at their disposal and can help you, get to the place that you want to go. Number is 877-245-2030. We're coming up on a break. We're going to get into the multiple offer situation and why buyers are, losing out on many deals because there's 5 and 10 offers on every property they write a contract on when we come back. Stay right there.